Hello everybody, welcome to today's fundamentals. Hello Peter.
Hello.
A new day, a new week. What's up in the markets?
Well, we had the US dollar, which seemed to be edging a little bit low on Friday. Yet I think that we may be seeing a stabilization during today's Asian session and early European one. The fundamentals behind it, we have to keep in mind that over the past 2 weeks we had data which showed that the employment market remains tight in the US. Inflationary pressures in the US economy remain high. Also, we note that we had a number of Fed policymakers which made statements over the past few days and highlighted more or less hawkish intentions that rates need to be raised even higher and be kept at high levels for a prolonged period of time. I would also note on the other hand, though, that there seems to be a certain optimism about a positive impact from China's reopening. And I think that's, on the other hand, more or less improving the market sentiment. Across the Atlantic, in the UK, the major fundamentals, on Friday we had the UK retail sales growth rate. It was for January, it accelerated more than expected. It got out of the negatives and showed growth once again, which more or less tended to imply that the average UK consumer is actually willing and able to spend more in the UK economy. On the fundamental side, I would be noting for pound traders that there are increased indications that the UK government is actually nearing a new Brexit deal with the EU, which tended to provide some support on a fundamental level for the pound. And should the news actually be confirmed, which may ease the burden on the UK economy, I think that could cause considerable support for the pound.
And how about US stock markets?
We had mixed signals. And that's not only on Friday, but in the past few days we had mixed signals from US stock markets. There seems to be a relative hesitation on behalf of US stock markets. Definitely the Fed's intentions are being closely watched. And any indications that more or less the hawkish side is being underscored, that could weigh on US stock markets. On the other hand, the relative optimism from China's reopening and a number of data which tend to imply that a possible recession in the US economy may be avoided or even be shallow, tend to support US stock markets. We have to bear in mind also, though, that it's still the earnings season. There's still a number of high-profile companies which have to release their reports. I would be noting among them on Tuesday we have the retailers Walmart and Home Depot. I would also be noting Nvidia, and I would be also noting Alibaba and Booking. The last one's on Thursday.
And what's on the calendar for today?
It's an easygoing Monday. We had already Sweden's CPI rates. There was a slowdown, but overall inflationary pressures remained rather high. It was characteristic that the Swedish krona strengthened at the time of the release, both against the US dollar as well as against the euro. I would be highlighting in the European session the release of, it's in the American session, and it would be the release of Eurozone's preliminary consumer confidence indicator. That's for February. A possible improvement could provide some support for the euro. On the monetary front, I would be noting in the American session that BOE's Woods is going to be speaking, and should she maintain a hawkish tone, that could provide some support for the pound. Should there be some hesitation, that could weaken the pound somewhat. And during tomorrow's Asian session, we make a start with the release of the preliminary PMI figures for February from Australia. We also note the manufacturing PMI figure from Japan. I think, though, the highlight of the Asian session tomorrow is going to be the release of RBA's last meeting minutes. We have to note here that over the past week, RBA Governor Lowe was before Australian lawmakers twice, once in the Senate, once in the House of Commons. He received a substantial amount of criticism from Australian lawmakers, and more or less, on the other hand, though, he stood fast. He maintained a firm stance, defied any political objections, and more or less maintained the view that the bank is going to be keeping its hawkish stance. Now, should that hawkish stance exactly be verified by the minutes tomorrow, that could provide some support for the AUSSIE.
And how about the rest of the week?
Well, we have a number of releases. I would be making a start tomorrow with the preliminary PMI figures for February. Especially, I would be highlighting for the Eurozone Germany's manufacturing sector. And overall, there seems to be a slight improvement, which could be a positive for the euro. I would be noting from the UK the preliminary services PMI figure. Should there be an improvement there as well, we may see the pound getting some support. I would be noting also on Tuesday from Canada the CPI rates, the core CPI rates, and the possible acceleration could solidify the hawkish stance of BOC and cause another rate hike. By the way, at the same time, we're also getting from Canada the retail sales growth rate. On Wednesday, I would be highlighting definitely the release of the Fed's meeting minutes. There has been lots and lots of commotion over the past week about the Fed's intentions. I think we're going to be getting some clues here, and definitely the document is going to be scrutinized by analysts and market participants. Other than that, I would be noting from Germany, also on Wednesday, the release of the preliminary HIC period for February, a possible acceleration. Mind you that also January's final HIC period is going to be released. A possible acceleration could provide some support, while a possible easing could weaken the common currency in the sense that inflationary pressures in the largest economy of the Eurozone seem to be cooling off. And moving on to Thursday, when we're getting the highlight is going to be most probably the second release of the US GDP rate. It's for quarter 4. But I would also be noting from Turkey the release of CBT's interest rate decision. And last but not least, on Friday, we get a number of data from the US, among them the consumption rate, the core PCE price index, and I would also be noting the final version of the University of Michigan Consumer Sentiment.
Great. Thank you, Peter, for your time, and everyone for watching. Join us after a short break for technical analysis with Peter Iosif.
Welcome to the technical analysis part of the presentation. My name is Peter Iosif, Senior Market Analyst at IronFX. In front of your screen, you have the US dollar index for our chart. All charts to be presented are to be of the same time frame, unless otherwise stated. With no time to waste, we note that since Thursday, the US dollar index rose, broke above the 103.75 resistance line, corrected lower. It's interesting how the resistance line, former resistance line, is now providing support. See how it provided resistance here, and now it's providing support here. So definitely we have to correct this level and turn it from a resistance to support line. Let's go hunting for a new R3. Unlocking the chart. There's a peak. it is. Cancel, and that would be the, in red, 107.80. Let's magnify it a little bit. Could be slightly higher. Just to catch that shadow here there. Okay, 107.85. That's it. Locking it in. Readjusting the chart. Zooming back out. Here we go. Repositioning the labels. Let's correct the labels as well. $100.70 at the R3, 102.45 at the S2, 103.75 at the S1, sorry. At the R1 is now being placed at 105.40. The R2 at 106.80. And the R3 at 107.85. Locking everything in. Here we are. Now let's talk direction. Definitely we note the steep drop here on Friday. And it would be interesting as practically there was an upward trend line which has been broken. So A, given the fact that the upward trend line has been broken. B, given the fact that the price action respected the 103.75. C, note how the RSI indicator is running along the reading of 50. All of that tend to imply that we have a change of trend, B, there seems to be a relative stabilization and a sideways motion prevails. So hence we switch our bullish outlook in favor of a sideways motion. I wouldn't be surprised to see the price action remaining just above the 103.75 support line or even revolving around it. Should the bulls take over, we may see the price action rising and aiming, if not breaching, the 105.40 level, which provided resistance beautifully here. On the other hand, should the bears take over, I would expect the price action to drop, break the 103.75 clearly, and start aiming, if not even testing, the 102.45, a level which provides support here and resistance here. Sorry. Let's move to Euro USD. In a similar but reverse motion, note how the price action has broken the downward trend line guiding it and has stabilized just above the 1.0655. The RSI indicator is also near the reading of 50, just below it. It's actually right now at 49.3. Note how the Bollinger Bands have narrowed, implying low volatility. So we may be seeing a stabilization being maintained and a sideways motion prevailing here as well. Should the bears take over, given that we have still the 20 moving average, the 100 moving average, let me change the 200 to 100, and the 100 to 50. See how there is a downward motion on all three of them. Should the bears take over, we may see the price action dropping, breaking the 1.0 0.655, something which happened here as well. And in that case, though, we would expect the next show to be lower than this one. So that would mean that the pair has to start actually clearly start to aim for the 1.05 support level. On the other hand, should the bulls take over, I would expect the price action to rise and start aiming, if not even breaching, the 1.0790, a level which provides resistance here and here. Cable, GBP USD. Similar picture with the euro. There was an intense downward motion characterized by a downward trend line. The pair even broke below the 1.1970 at some point, but it corrected far higher and stabilized during today's Asian and European sessions. So given that the RSI indicator is at the reading of 50, just below it, given that the downward trend line has been broken, we switch our bearish outlook and maintain a sideways bias for the pound against the US dollar as well. Once again, the narrowing of the Bollinger Band tends to reflect exactly this lowering volatility here. Should the bears be in charge or take charge once again, if you prefer, we may see the price action dropping, breaking the 1.1970 and start aiming for the 1.1840. On the flip side, should the bulls take over, we may see the price action rising and aiming, if not even breaching, the 1.2215 resistance line. Actually, I would require a higher peak than this one for a bullish outlook. Moving now to USD/JPY. In a similar fashion, despite a steep upward motion, there was a correction after hitting on the 134.75 resistance line and a stabilization just below it. So we switch our bullish outlook in favor of a sideways motion, possibly below the R1, just below it. Mind you, the RSI indicator is still above the reading of 50. It's actually not that far off. It's at 57, but seems to be dropping towards 50. So that doesn't actually imply that there are any bullish tendencies left. On the contrary, it tends to imply that the bullish effect in the market or the bullish sentiment in the market is slowly fading away. Note though that we have the 20 moving average, we have the 50 moving average and the 100 moving average all pointing upwards. So should the bulls find another chance and take over, we may see the price action rising, breaking the 134.75, that would be a prerequisite, and start clearly aiming for the 137.80. On the other hand, should the bears take over, we may see the price action dropping, breaking the 132.85 and start paving the way for the 130.40. Moving now to USD/CHF. That was an interesting movement. Note how the price action was able to break above the 0.9275. That was a very beautiful break, and there was an intense upward movement here. That is. Yet the pair corrected lower, broke below the 0.9275, so that turns it back into a resistance line, and actually maintains a rather downward motion. But note how the bears hesitate. There was this bullish candlestick here, while definitely the candlesticks here are very, very narrow if compared to the downward motion where we had 3 black crows here. 1, 2, 3. The RSI indicator has reached the reading of 50, seems about to flatten out, but still has some slight downward inclination. It's actually right now at 48. For the time being, I would expect the pair to stabilize, or at least the bears are going to be having some difficulty in advancing, or if you prefer, pushing the pair lower. And I would expect a stabilization of the pair. Maybe even a correction slightly higher, but always below the R1 0.9275. Should the bears actually accelerate, we may see the price action of USD/CHF dropping further, more intensely, this time reaching, if not even breaching, the 0.9145. On the other hand, should the bulls take over, we may see the price action reversing direction, breaking the R1 0.9275, and start aiming for 0.9405. Okay, let's move to AUD/USD. A very, very similar picture. Very, very similar picture. The price action of the pair dropped, broke the 0.6880, reversed, and backed up just once again. Once again, the characteristic element is the breaking of the downward trend line. So, given also the fact that the RSI indicator has stabilized currently at the reading of 50, we tend to switch our bias for a downward motion in favor of a sideways movement just above the 0.6880, possibly revolving around 0.69. Should the bulls advance further, push the price action further higher, we may see it aiming, if not even breaching, the 0.7010. On the other hand, should the bears regain control, I wouldn't be surprised to see the price action dropping, breaking the S1 0.6880, and start aiming for the 0.6740 support level. Moving now to USD CAD. Another interesting chart. Let me draw the upward trend line which characterized the pair's movement, and it's just been broken. It was interesting how the pair attempted to break above the upper boundary of its past sideways motion. Yet I think that seemed to be ending in a failure and slowly correcting lower. I wouldn't be surprised to see the pair correcting even lower or even start to stabilize right now. For the time being, we switch our bullish outlook in favor of a sideways motion just below or around the 1.3470 resistance line. The RSI indicator is still above the reading of 50, it's at 57.5, yet is dropping. And should there be a further drop, that would be practically aiming for the reading of 50, it's stabilizing. Should the bulls regain control, we may see the price action reversing direction, breaking the 1.3470, and start aiming for the 1.37. On the other hand, should the bears take over, we may see the price action aiming, if not breaching the 1.3285 support line. Let's have a look at the Kiwi. We have an interesting element here in the sense that it seems as if the downward trend line is being maintained. Yes and no. Actually, it seems to be broken. Okay. Definitely, though, the pair has broken below the 0.6270. It's beautiful how it bounced just above the 0.6190, a level which has proven its worth once again. Note how it provided support here as well. Okay. Definitely the S1 will have to be turned into a resistance line before we discuss anything else. Let's go hunting for a new ultimate support level. Now this is a level which provided resistance here and here, and support here. Seems to be pretty valid. I'm going to be keeping this as a support line. The new S3, which is now being placed at 0.5940. We're adjusting the chart. Let's correct the labels. Let's make the necessary corrections here, starting with the R3, which is now being placed at 0.6465. The R2, which is being placed at 0.6360. The R1 at 0.6270. The S1 at 0.6190. The S2 at 0.6060. And the S3 at 0. Let me correct that. That should be 0.5940. Yep. 0.5940. It is. Locking everything in. Now let's discuss direction. Definitely the breaking of the downward trend line tends to imply a sideways motion in our opinion. Why? Because there's also relative stabilization. On the other hand, though, we cannot overpass the fact that we have the 20, the 50, and the 100 moving averages all pointing downwards. Different inclinations, but downwards. The RSI indicator has risen, yet it was not able to reach the reading of 50. It's actually right now at 39 and has flattened out. So there's still some residue of a bearish sentiment in the market. In my opinion, I would be switching the bearish outlook in favor of a sideways motion and stabilization between the 0.6190 support line and the 0.6270. Yet, I would also be noting the possible bearish tendencies for the pair. Should not take this by surprise. Should the bears actually take over, we may see the price action dropping once again, breaking the 0.6190 and start aiming for the 0.6060. On the other hand, should the bulls take over, we may see the price action rising, breaking the 0.6270 and start aiming for 0.6360. Let's have a look at gold. It's interesting how all the pairs seem to be technically USD driven. Note the downward trend line, far wider one this time. and it has been broken. Definitely this has to be deleted. There's a relative stabilization. Note how low the volatility is, and it remains above the 1830. The RSI indicator is running along the reading of 50, implying a rather indecisive market. Hence, we switch our bearish outlook in favor of a bias for a sideways motion to continue for the time being. It's interesting how there are some slight bullish tendencies here. Note the slight green candlesticks, but nothing conclusive. Now, should the bulls take over, we may see the price action rising, and I wouldn't be surprised to see it aiming, if not even breaching, the 1880 resistance line. On the other hand, we have to note here that we have the 50, the 100, the 50, and the 20 moving average all pointing downwards. So there may be some bearish movement here, in which case we may see the price action dropping, breaking the 1830, and start aiming for the 1785. For the time being though, once again, given the breaking of the downward trend line right here, we tend to maintain a bias for the sideways motion to continue, at least at a temporary level. Let's have a look at US stock market, starting with Dow Jones. Okay, there's a wide sideways motion, and that seems to be maintained given that the price action has bounced beautifully on the 33,460. On the other hand, note that we have one peak, then a lower peak, then an even lower peak. The same applies also with the trues, 3 consecutive lower trues, but I'm not convinced for the bearish tendencies yet. For a bearish outlook, I would require a lower true than this one. That would mean practically a breaking of the 33,460 support line and the price action of Dow Jones to start aiming for the 32,500. On the other hand, should the bulls take over, we may see the price action reversing direction, breaking the 34,400. That would be a signal that the upward trend line may be slowly but steadily playing out here, and that would be intensified should the price action of USD from the US 30 Dow Jones start aiming for 35,500. Let's have a look at Nasdaq. Okay, Nasdaq, we get a slightly different picture here in the sense that it has dropped, broken the 12,450. That has to be switched, cancel, and be turned into resistance line in red. Locking it in. Let's go hunting for a new support level. Now, I would be noting this one first. And that would be in green, 11,575. Let's widen the chart a little bit. There we go. Let's correct the positions of the labels. Correct the content as well. R3 now being placed at 13,145. The R2 at 12,825. correct that. 12,000. My bad. There are one at 12,540. The S1 at 12,220. The S2 at 11,845. And the S3 at 11,575. Liking everything in. Here you go. Let's talk direction. The price action dropped considerably, yet actually failed to break this one. In the big picture, there seems to be a wide sideways motion. In our opinion, though, I would be noting that there was an interesting mid-level, and I'm keeping that. Yet the sideways motion prevails, possibly between the 12,540 and the 12,220. Mind you that the RSI indicator has flattened out below the reading of 50. It's actually at 42, which may imply that there's still a residue of bearish sentiment left in the market, which should not be underestimated. Should the bears though take over, we may see the price action dropping, breaking the 12,220, and start aiming for the 11,845. Note how beautifully the level provides support here. On the other hand, should the bulls take over, I wouldn't be surprised to see the price action breaking the 12,540 and start aiming for 12,825. We could narrow this and bring it down here. It was repeated, so I'm keeping that level. And that will be the 12,760, locking it in. Note how the price action has been moving in a sideways motion practically since here. It's a beautiful sideways motion. Let me just switch it to light yellow. Here you are. Okay, let's move now to WTI. Definitely the S1 has been broken, and that's clear as day. It's interesting how the price action of WTI seems to be on the rise since the late American session on Friday and today. On a fundamental level, I would be noting that possibly the reopening of China tends to create hopes for a positive effect on oil demand, which may be outweighing any worries about a recession in the US, for the time being at least, and the Fed's hawkish stance. Let's go find a new ultimate support line. We have to go way back. Here it is. Let's readjust the chart. Let's correct also the positions of the labels. Note the mid-level. Starting with the R3, which is now being placed at 89. The R2, which is being placed at 82.65. The R1 at 78. The S1 at 73.60. The S2 at 70.30. And the S3 at 66.60. Let me check the last level. Yep. Locking everything in. Now what's interesting about the chart, we mentioned it. We had 3 red continuous strong candlesticks which have been stopped. And the upward motion has broken the downward movement. So I would expect a relative stabilization. The RSI indicator is nearing the reading of 50. It's actually right now at 44, which still implies that it has some way to go. But it's rising. It bounced on the reading of 30. So I would expect a stabilization below the 78 resistance line for now. Yet should the bulls take over, we may see the price action breaking their 178 resistance line and start aiming for the 82.65. That should sum it up from all of us here at IronFX. Best wishes for solid trading.
Hello everyone, my name is Emily. In our video today, we will talk about why having a forex trading strategy is important. Trading on the global forex market presents the opportunity for a quick profit turnaround for traders and offers significant potential. However, as the most liquid market in the world, it is both complex and highly competitive. This means that in order to be successful, you need to have a solid trading strategy in place. Forex can be traded in numerous ways, so it is very important that you go with an approach that suits your experience level, budget, and trading goals. Having a proper understanding of the market you're entering into and the strategy that is needed can be the difference between trading success and failure. Choosing a forex trading strategy is similar to buying a new car. There are a lot of choices and they come in different types. It is also important that you test drive a new strategy via demo account before proceeding with it on the real world markets. Thank you so much for watching us today, guys. Bye-bye.
Good afternoon. Hi, Atur. Hi, Owen. Just want to check that you guys can, before we get started, you can hear me okay? You can see me all right? Let me know, put it into the chat. Sound and screen okay? Fantastic. Seems like everything's okay. We'll give it a couple of minutes before we get started. And while we're waiting, let me know where you're joining me from. And I hope you've had a good trading day, or trading week, or good start to the new year. And a happy new year to everyone as well. Hey Techno, how you doing? Hey Aya. We'll see who else streams in before we get started. Give it a couple of minutes. Today we're here with IronFX on the webinar series Mastering Divergence in Trading. Quite a number of things to get through today, so it'll be quite an interesting session. I hope you find it an interesting session and helpful as well. Hi there from Germany. Good to see you. Hey Esther, how are you doing? As we're going to be talking about divergence trading today, let me know if this is a strategy or method that you deploy onto your own trading as well. Do you use divergence? Do you trade with the divergence? I'm very well. I've had a couple of nice trades last night and also this afternoon, so I'm super happy with that. Hey Promise, how are you doing? Fantastic, good to see. Does anyone attending the session use divergence in their trading? Why I'm asking is just so that I know, how fast or how slowly or how much detail to get into, customize the session a little bit more for you guys. And do let me know. Alrighty, let's get started. So again, welcome to everyone attending the session, and thank you all for attending the session. I know a couple of you have been waiting to join up, so thank you all for attending early and welcome to the session. Today we are here with IronFX on the webinar series Mastering Divergence in Trading, right? So before we get started, a quick disclaimer is that any information in this webinar should not be construed as investment advice or an investment recommendation, but instead as educational material only. This material is the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered IronFX is not responsible for any loss arising from any information contained herein. What it means is that I will be sharing with you some ideas, some thoughts, the way to deploy divergence in your trading. What I do usually recommend is that whatever you learn here during this session, I would suggest that first you test it out, right? You read up a little bit more about it, you understand it a little bit better, then test it out on a demo account first, right? Never jump straight into a live trading account with a new strategy or a new method. What you're gonna do is test it out on a demo account. Make sure that you understand how it works. Make sure that you're able to identify the way it works on a demo account. Then you progress on to trade it, I would say, on a smaller trade, right? So size down when you go into a live account, size it down, test it out further. Once you gain that confidence with the method, then you can resume and possibly integrate it with your existing trading strategy. Okay, so these are all, I feel, complements to your trading strategy, not something that I think should overtake whatever you're currently doing. All right, so a quick introduction. My name is Jindao. Most of you will know me as Jin. I've been trading for 10 to 15 years now already, so quite a long time. If you do have any trading related questions, please feel free to reach out, let me know. I'll be happy to address your questions as they come up. Okay, so today we're talking about divergence when we are in trading, right? Using different price levels and also the tools and indicators to help us to identify possible divergence. All right. Good to go. Any questions at this point? I do see that a couple of you are new to trading. So what I would suggest is that, this might be something that you want to look further into. It is a very powerful and quite commonly used method that a lot of traders monitor and deploy with their trading. So I think this might be a good starting point, right? And it's relatively simple to understand, relatively simple to analyze and to deploy. So it might be something that you might want to look into a little bit deeper as we progress through this session. So with that, let's get going. A couple of things to get through today. First off, obviously, what is divergence in trading, right? What is divergence in trading? And, as the word, let me just get that up. As the word suggests, divergence, right? Just plainly explained, in divergence means one thing is going towards upside and then something else is going in opposite direction, right? Obviously, everything is moving towards the right, but one is moving higher and then something else is moving lower. Or in the flip side, I should change the color. Let me just do that. All right. Or on the flip side, one goes down and then the two goes up. That's a terrible color. Sorry about that. Okay. So first off, what is divergence in trading? That's when we actually see price moving. So I always say that top level here is price. Price moving in a different direction to what the indicator is telling you. I can't scribble with the mouse, but what the indicator is telling you. So very commonly, most often, we always see, price moving in the up towards the upside, and then we see the indicator pointing towards the upside. So this is the common view, is that we see price pushing higher, while the indicator, for example, the RSI, is pushing towards the upside as well. So that's what we saw. We say a confluence, we would say it's moving in alignment, right? Indicator pointing in the same direction as price. When it comes to divergence, it's when price moves up, but we actually see the indicator pointing towards the downside or moving lower. What indicators can you use to identify a divergence? First off will be price at the top, but in terms of indicators, we can use the stochastic, right? We can use the stochastics, we can use the RSI, or we can even use the MACD, the moving average, convergence, and divergence. Quite commonly, the question I would get when I come to this point is that, people will be asking, so which is better? Should I, is the stochastic better than the RSI, or is the RSI better than the MACD, just based on the sequence that we're sharing? There is no better indicator to use. It all performs in a similar fashion, right? All performs in a similar fashion, but what it should actually tell you a similar story, identifying that similar setup for you. So it really doesn't matter whether you use the stochastic, the RSI, or the MACD. Sorry about that. I'm still coughing terribly, so just bear with me there. Okay, so different indicators still would tell you a similar story. Then after that, on point 3 here, so this is 2, and this was 1. On point 3 here, we have different types of divergence. Different types of divergence. There are normal divergence, there are hidden divergence, and the exaggerated divergence. Now, put it into the chat. What do you think is going to give you a bigger possible potential move when you identify divergence? Normal, hidden, or exaggerated? What do you think is going to give you a bigger price movement? Normal, hidden, or exaggerated? Okay, right? Yes. So good stuff there, right? It exaggerated tends to give you, or would tend to give you, a bit more of a potentially bigger price movement. But there are other things to consider, not just the types of divergence. And then with that, when we understand how to use the indicator, how to identify the different divergence, we'll combine them all together to look for our trade setups. Okay, so quite a number of things to get through today. At any point, if you do have questions, please feel free to put into the chat, let me know. And also, if time permits, what I'll do is at the end of the session, I'll jump into a live charts and try and identify some divergence or live occurring divergence for you guys. Sounds good? Alrighty. So first off, jumping ahead a little bit, the different types of divergence. Like I was telling you, okay? So I remember that on the top, splitting this, on the top is price, on the bottom is indicator. So there's the blue line and the red line. That's the regular divergence. The hidden divergence, again, price and indicator. And then the exaggerated divergence in terms of price and indicator. Okay, so how do you identify a divergence? Right, let's look at the regular divergence first. How do you identify a regular divergence? We split the divergence up into a bearish divergence or a bullish divergence. As the name describes, if we have a bearish divergence, what we anticipate is for price to drop strongly. If we have a bullish divergence, then we anticipate that price should climb higher. So things to pay attention to is the turning points on price, right? So we're looking for price to move up, turn back down, move up again, turn back down. So we have a higher high, and then another higher high. So when you have higher highs, you say that that's the first part 1. Okay, this is what we have here. And then you look at the indicators, right? For example, in this case, let's say the RSI, and you're looking for it to form a lower low. So in this case, as the indicators might go down this way, bounce back up, turn back down, and then turn this way, you say this is a low and a lower low, right? So you say that we have a divergence, a bearish divergence. Price forming higher highs, or the peaks of price forming higher highs, and the indicators forming lower lows. All right, so with that, we will anticipate that price would retrace or correct towards the downside. Remember, the things to remember here is that when you're looking at bearish divergence, you're almost somewhat identifying a upward trend line, right? Or trend line that's resisting, providing that resistance to price, right? So it's hit the price resistance once, twice, and then a big retracement towards the downside. In terms of a bullish divergence, you're looking for a lower low in terms of price, a lower low in terms of price, and a, when price goes this way, no, let me do that again. All right, so when price goes this way and then this way, so now we have that trend line towards the downside, and then we have a lower, a higher low, right? A higher, this will be a lower high. Pardon me, this will be a lower high. Then we have that divergence towards the upside. So they will call this a bullish divergence. Okay, so I'll take that away. I think the regular divergence is relatively straightforward in terms of identifying it, because we're looking for that higher highs and the lower highs in terms of the bearish, and the lower lows and the higher lows in terms of the bullish divergence. What happens with the hidden divergence? What happens with the hidden divergence is when you actually see price moving lower. So you have in this case, a high, and then we have a lower high, while we have the indicator actually giving us that, a high and then a higher high. All right, so it looks like it's pointing towards, it looks like those lines will be converging, pointing towards the same meeting point. That's what we'll have, the hidden divergence, a bearish hidden divergence. And then when we look at the bullish divergence, it actually separates out, it points further apart. You can see here, it's formed by a low and then a higher low, right? A low and then a higher low, while the indicator will be formed with a low and then a lower low, where you would have the divergence pointing in separate directions, one pointing towards the upside, one pointing towards the downside. That would say a bearish, or rather a bullish hidden divergence. And then lastly, the exaggerated divergence. That one is relatively straightforward to identify, because we're looking at price not forming that diagonal move, right? We're not looking at a higher high or lower high in what we had on the regular or the hidden divergence. What we're looking for in the exaggerated divergence, whether it's bullish or bearish, we're actually looking at price trading or forming a good strong horizontal resistance or horizontal support level. Okay, so you can see here where we have here at this point, price testing, before testing again, horizontal level, right? A horizontal resistance, not looking for the higher highs or higher lows, and then but the indicator forming a high and then a lower high, right? So you have price resisted to move towards the upside, but yet you have the indicator pointing towards the downside or trending lower. That's why we say we have the exaggerated divergence. on a bearish note, and then on a bullish note, we'll have it forming a support level, right? At a support level, while the indicator is forming a low and then a higher low, indicating further upside or indicating that bullish potential. All right. So quite a number of things to take note of in terms of identifying or understanding the different types of divergence. While this session is being recorded, what I will also suggest to you guys will be to, take a quick snapshot or do a quick scribble in terms of the the 6 different divergence: the bullish, the bearish divergence, for the regular, for the hidden, and also for the exaggerated divergence, right? So this, you can use it as a quick reference guide. Okay, so if you have already, great. If not, let me know. I'll come back to this slide again. So looking at it in terms of on a chart, it's fine. It's relatively easy to identify it when we're looking at it with lines purposely drawn to identify the divergence. But how does it look like on a chart? We have the examples here. You can see that firstly, price is testing a resistance level, right? It's formed. It's almost, if I can draw a horizontal line, you can see it's formed right across, right? Forming a little bit of a smaller high, resulting in a bearish divergence with RSI. So it's tested a bit across, but you can see that in this case, it's moved up a little bit, right? So we're talking about small movements. It can also sometimes be quite obvious, right? Sometimes it's quite hard to identify a divergence or bearish or bullish divergence, but sometimes it's going to be quite obvious. In this case, as a first example, almost horizontal, almost like an exaggerated divergence, but we also would say that it's a bearish divergence here. And then you can see RSI first at this point, and then trending lower, right? So this is a little bit more obvious. You can see it pointing towards the downside. So we either have it going up like that slightly, potentially, and then after that, the RSI forming that. Oops, I'll draw that better. And then the RSI forming that move lower again, right? So we're looking at that. And then if I scroll back, you can see that for this to point up and this to point, the indicators trend to point down, right? Pointing up and pointing down, or moving right across and pointing down. So this would tick the examples of either a regular divergence or the exaggerated divergence, which still would give us the indication that we're looking at a potential bearish move towards the downside. Okay, so you can see here, price moving across, right across or slightly towards the upside, and then the RSI here moving slightly lower, right? So we see that divergence, that bearish divergence. And what happens? You see that price traded strongly lower, right? Strongly lower, not just because of the divergence, right? Price reverses strongly from that horizontal resistance level. It also traded lower because the RSI traded down, right? From the overbought region to the almost towards the oversold region. And also because of that bearish divergence. So what I'd like to do, right, as much as we're talking about the divergence here, right, as much as we're talking about the divergence here, I wouldn't recommend, entering a trade just because of a divergence. I wouldn't do it just because of a divergence, right? I'll still be looking at, yes, I'll identify a divergence, but before that, I'm looking at support and resistance levels, right? You can see price resisting that resistance level. You could also be looking at the previous trend. And also you'll be looking at indicators just giving you that signal of where price could be heading towards. putting all that together, then after that, identifying a divergence gives you that confidence, right? Gives you that confidence because you get a confluence of analysis. You get many things put together, giving you the same signal, telling you that we're potentially looking at some downside. And that's why we see price having moved strongly lower. All right. At this point, any questions? Any questions at this point? Let me know. Or if it's all good, clear and good, let me know as well. And we'll move on. Alrighty. Okay. So with that, thank you, Esther. With that, we look at, again, another one, right? An idea of a repeated divergence. So now let me ask you, if you see a divergence and it trades well, and what happens? What do you think will happen if you see multiple divergence? If you see it happening over several times? Most likely going to give you a stronger signal, right? A repeat of what could happen. So in this case, quite straightforward. You can see that price pushing higher, right? Moving towards upside there. Oops, I'm terrible with this drawing. Right, you can see price forming a higher high. You can see price having a high there and then forming a higher high. But yet we see the stochastics. In this case, in this example, we're looking at stochastics forming a lower high, right? So this was the high point here, and then it's formed a lower high. So it's pushing towards the downside. Again, as price pushes up and the indicator, in this case, the stochastic pushes down, what we would have is a bearish divergence. And you'll see that, if I can just draw a straight line across, that was the previous resistance level, right? We saw a little bit of a break towards the upside. And then because of that bearish divergence, we saw price come strongly towards the downside. Okay, so this is also one good way or another tool to help you identify potentially some false breakouts. I always get questions from individuals that I coach in terms of how do you identify a potential false breakout. You could use divergence as price breaks out of a resistance level. You see a divergence form, you anticipate that price could trade back down again. In this case, you can see as the divergence forms, we see price trade lower. All right. So what is a repeated divergence? You see again, if I take that away. Okay, if I take that away, you'd see that now we have that high and that forming slightly lower. Again, a slightly lower high on the stochastics. Right? No, they're here. Okay, high there. One formed, and then after that, this formed here. But yet, price is moving towards the upside. Again, another bearish divergence. I was just sharing with you before, just as I was drawing that, why this wouldn't work is because as much as we see this moving a little bit across, a little bit towards the downside, we haven't seen price, or price rather has been trading right across. It hasn't really turned towards the upside. We haven't seen a higher high, right? Or we haven't seen it turn down from that resistance level. So it hasn't really formed a divergence yet from this picture, right? So we have one divergence formed here. And then as price goes up, you'd say that there's another divergence as we see this push higher while the stochastic pushes towards the downside. Okay. And what's very interesting here at this point is also to identify that this is a bit of a resistance level formed on the stochastics, right? It's also a resistance formed on the stochastic where you see that it's hit that level here and turn back down, again hit that level and turn back down. could be also considered as a hidden resistance level. Why is it hidden? Because we normally draw the resistance level on the price charts, not on the indicator chart. All right. So with this repeated pattern at this point, well, what could you anticipate? We'd say that we anticipate for price to turn down because of that bearish divergence. And that's where you see price shooting towards the downside as that bearish divergence forms, as it retraces or breaks out from that upward move. Okay, so we've gone through just a couple of divergence at this point. Firstly, the normal divergence, right? Just a quick introduction of the normal divergence, and then also the repeated divergence where you see it happening once and a relatively small move towards the downside. But then after that, when you see it happen twice, a repeated pattern, you see a bigger move tracking lower, right? A bigger move towards the downside on the bearish divergence, because it's already happened once, small move, and it happened again, we see that big move down. Okay. So with the divergence, as we were looking at it, you have that high, that higher high. So this was a high point. This is a higher high. And then also when you have the stochastics or the RSI or the MACD giving you that lower high. I'm just trying to draw it properly. High point and then that lower high point, right? So when you have that pointing down and then that pointing towards the upside, we can pretty much identify where is an entry point. Where's an entry point is when the turning points align, right? I didn't draw it exactly. I was trying to struggle to draw it a bit, but when the turning points align. So in this case, you can see at that dotted line, I would say as the candle closes, just to ensure that you see that downward move or that pivot level, you'd say that would be your entry level, right? Your entry level. Then the common question comes is, wait, so if I know that at this point, that's my entry to sell, right? The entry to, let me just do that again. It's terrible to try to write with a mouse. Right? That's where you would be looking to sell. Then what happens is the next question comes with, okay, great, Jin. If I'm looking to sell at this point, where's my take profit going to be? All right, where's my take profit going to be? This case here, where the divergence started. It could very well go a lot lower than that point, but you'd say that your first target could be at your take profit would be here. That'd be your first take profit level. You might be looking to close out half the trade at that point, right? What I would suggest is you could be looking at closing out half the trade, right? Or you could be looking at moving your stop loss to break even when price comes to that point. Or, well, you could be looking at closing out the trade completely with your take profit. Okay, so you say that if I'm looking to sell at the formation of that divergence, my first decision point will be at the take profit level where the divergence started. My stop loss, I would say, would be above that previous high as your stop loss level. Okay, so relatively tight. You tend to have relatively tight stop loss when you're looking at divergence, when you're looking to trade divergence. That's why I suggested at the start that this might be quite a good starting point for a lot of new traders, right? You have a relatively tight stop loss, and then your take profit. If you're not so risk seeking, you could be looking to close out exactly where it started, or you could be looking to close out half the trade or any amount of trade, or you could be looking to move your stop loss down to the break-even level just to protect the trade and see how far down it can go. Okay. So in this case, you see that as we spotted that divergence, right? We were looking to sell at this point here. Our stop loss would be above, either above that previous high or above that divergence. I would say at about that point. And then your take profit would be at this level here. Okay, you see it come down, come close, bounce back up, and then after that, complete that reversal to hit your take profit level where it first started, where that first divergence started. Okay, in fact, here's another divergence that you could have entered on the shorter term. All right, and we'd say this would be the exaggerated version of a divergence. You can see that price moving right across. Right, so a horizontal movement or horizontal resistance on price, and yet we also at that point see the RSI in this case forming a high and then a lower high. So with that, if I can draw a straight line down, almost did it. Right, as that forms, you see that price shot towards the downside with that divergence forming as well. Right, so it's not just that big move that you have identified. You can identify other potential divergence within one move. Right, so you could have one trade. I would say this would be your first trade, and then as price comes down, bounces back up, you form another divergence, and then this would be your second trade towards the downside. This would be number 2. Okay, so in one move, over a medium long period of time, you could have multiple divergence being formed. I didn't see that question there. I didn't see anyone raise that question. When, so commonly what the question I'll get is when, in terms of time frame, can you use or can you look to identify a divergence? So this can be done, or divergence can be identified on any time frame. Okay, you could be looking at it on the daily time frame. Oops, not the P, it's a D. Right, so you could be looking at it on a daily time frame. You can looking at it on the H4. You could be looking at it on the H1 even. Right, but as much as it'll work across everything, I would say that M15 might be the lowest that you go down towards. Right? I wouldn't actually look at anything lower than that, because what happens is that anything lower than H1 tends to get a little bit noisy. You see price fluctuating around with quite significant or choppy price movements. So if you try and identify it on too small a time frame, what you might actually get is possibly a lot of divergence in terms of occurrence of a divergence, but it might not all play out very well. Okay, so I would say that if you really have to, or if you should keep it to the daily, the H4 or the H1 time frame. And if you really, really have to, with nothing else to do, then you might consider the M15 at the very lowest. I wouldn't trade it any lower than that, any lower time frame than that. Fair enough? Good stuff. Okay, so with that, right, we'll be looking at forecasting. Right, forecasting. We put it all together. We try and identify where price could be heading or has been heading, and then how it could turn with a divergence. In this case, you see that the RSI broke the trend line or broke the supporting line before price did. Right, you see that moved down, but yet you identify this. Okay, you identify a lower high, and then here forming in this case, a higher high, right? A higher high. So straight away, we can see that a bearish divergence is formed. In this case, using the RSI, a bearish divergence is formed. Price broke the RSI broke the ascending support, indicating that price might trade significantly lower Then after that, we look into price breaking out the ascending support line, right? Showing again, similar to what we identified on the bearish divergence, because at that point, we're anticipating for price to move lower. We're looking for that big downward move. Okay, so you're actually combining a few analysis together. Not just, remember, it's not just the divergence. You're looking at trend. You're looking at support, resistance. You're looking at the indicator itself. All that add together with the divergence. Sorry for the scribble. What it ends up with is we're going to see a higher probability trade setup for potentially big move towards the downside, right? And you see that big push as it not only has a divergence, but it breaks the trend line as well. Fair enough? All good so far? Okay. Similar thing here. You see that price has been resisted by that trend line, right? Price has been resisted by that trend line as it trades lower, right? As it trades lower, first thing, how do you like get ready or get preempted to look for potential divergence is when you see the indicator giving you that early signal, right? You see that trend line towards the downside again on the RSI here, and then the indicator, and it gets resisted here, looks to break out of that trend line, of that downward trend line. With that, you'll be going, okay, great. It's looking like, or the indicator is indicating the potential for some upside. From there, you'll be looking at, can I identify any potential divergence? So in this case, you see price forming a lower low, right? Price forming a lower low, but the indicator forming a higher low. So what happens when you have a lower low in terms of price and a higher low in terms of the indicator? We're going to have a bullish divergence, right? It forms up with a bullish divergence. And as the RSI breaks above that trend line, we're going to see that potential for the upward move. Even as that divergence is formed, let me just do that straight line again to the best I can. Right, even as that divergence is formed, we already see price moving higher. So that's your first move. Sometimes you will not be able to catch that move straight away. You might not be looking at the charts during that time. You will see a divergence or bullish divergence formed. You might have missed that first move, but as price looks to break out of that trend line, break above that trend line, you can also see that if it breaks above that trend line, I have a bullish divergence supporting this analysis for that potential move or big move towards upside. And then you can see that as it breaks out, we see not a steep move, but we can see price trading higher along with that bullish divergence and that trend line. Okay, so this is another way to add on, all right, add on to not just a plain divergence. You'll also be looking at adding the trend line to it just to help you identify a potentially bigger move as well. Okay, so sometimes as I teach a lot of traders how to use a divergence, they might not spot it right at that point because you're not watching the charts. But if you identify a divergence after it's happened, you could also be looking for additional information as it breaks above a trend line or a resistance level. You're going to see a potentially bigger move towards the upside or the downside. Any questions so far? All right, we've come to the end of the slides. So I just want to check if you've got any questions so far. Just let me know. I'll give you a couple moments to check, to type it up if you've got any questions. Okay. This is recorded. I think you can possibly head to the YouTube channel. I'm pretty sure it will be uploaded there. If not, you can probably reach out to one of the guys at fantastic guys at IronFX. I'm sure they will be able to get you a version or recording of this session. All right. Oops, let me move that away. Okay, so like we were talking about, okay, so we're going to try and identify a couple of potentially divergence levels. Okay, so what you want to look for in terms of a bearish or bullish divergence. Let's look for a bearish divergence. This is on the, let's do on the H4 time frame. The hidden divergence is just when you have price. Let me just try and draw that out. Okay, so a bearish divergence is when it points, price does that. Okay, and then the indicator points this way. Okay, so you have a not the best drawn, but a lower high, lower high, and then you have a higher high on the price. For a hidden divergence is when it points in this direction. When price has a lower high, but yet the indicator is forming a higher high. Okay, so you're comparing these two together. So it's just pointing in different directions. Both of them are bearish divergence. Both of these are bearish divergence, but you just have price pointing in a different direction compared to the indicator. Does that answer your question there, Promise? Fantastic. Good stuff. Okay, so let me try and do this. Let's see if we can identify a couple of divergence. Tricky to do it on the spot straight away, so just bear with me for now. We could actually be looking at no, that doesn't form. Okay, so things to watch out for when you're trying to do a divergence. You can see that price in this case trading, forming a lower high, right? Forming a lower high in this case. And then after that, so you would think that maybe I have a hidden divergence here, but you say that on the RSI, this is also forming a lower high. So it doesn't work in this case. You don't want to try and force the analysis. We do have, nope, not here. Might have something here. A lower high formed, and then not the best. It does get tricky when you try and find something on the spot. Okay, let me just try and find another different chart, something that moves a little bit more steadily. Just wanted to make sure that I try and give you guys an example. All right, do we have something here? Okay. So we have price forming a higher high. Okay, so this is how we're looking at it. Price forming a higher high. And then after that, the indicator forming a, oh, don't have it there. It's supposed to turn to be down this way, so it didn't form. I was hoping to identify that. Okay, let's try this one. Price forming a downward move, and that's pointing towards the downside as well. I just want to find something. this way. Nope. It's all following in the same direction. Trying to H1 time frame. We might have something here. Okay. So in this case, we have price forming a higher high, while we have the RSI forming a lower high. Okay, you can see that price forming a higher high where we see it going this way, while we have the indicator forming a lower high where price goes down this way. All right, so that is what we call a bearish divergence, a regular bearish divergence, and that's why we can actually see that as the price as the divergence forms, right? Even slightly before that, as divergence forms, we can see price trading significantly lower. And even this case, you can even say that it's formed right across, but I think that it's more accurate when you say it's at that point. All right, I'm glad I found at least one example for you guys. Let's see if we can find another one. So a higher high here, higher high here in terms of price on the, and then after that, the indicator forming a lower high. Okay, so there you have it. Another example here. As price forms a higher high and the indicator forming a lower high, again, another bearish divergence formed on the US yen on H1 time frame. All right, does that make sense? It's hard to try and find it, so I wouldn't suggest trying to sit there and look for the divergence specifically, right? I would say that how I deploy or how I use the divergence is that when I identify a trade and then I somewhat identify a divergence, it supports the analysis that I was doing. It supports my view that, on my previous view and my previous strategy as well. Okay, so don't go sitting there trying to spot only divergence. It's going to be a rather futile effort. I would say that it'd be better to try and look for that moves instead. Okay, so we can also see here price pretty much trading right across, right? Price trading right across, but yet in that same period, we actually see the indicator pointing, or the RSI pointing towards upside. What we have here is the exaggerated bullish divergence. You see that at that point, right, as that's formed, price pushing strongly upwards. Okay, exaggerated bullish divergence is when you see price testing the same level right across, while the indicator forms a lower or higher low. All right, does that make sense to you all? As we come to the end of the session, I hope you found the information useful and interesting and useful. Thank you, promise. And if you do deploy this onto your trading strategy, please make sure you test it out first, build that understanding, build that confidence level, first on a demo account, then on a couple of small trades before you start trading, and complementing it together with your own trading strategy. With that said, I wish you all good trading ahead. Remember, trade well, trade safe, and I'll catch you again. Take care now. Bye-bye.